Our initial review has brought up several important issues the team would like to bring to your attention.
Okay, I'm Tracy, and I will talk about some key problems with how eChart record revenue and how it affects their financial and operations. First, eChart records a full 21,600 per users when the contract is signed. Even though the service is given over 3 years, the make revenue and profit look too high in the first years and leaves off future liabilities. Second, the company combines subscriptions, support, and professional service as one single amount, but under IFRS 15, this should be separated and revenue recognized when each service is actually delivered. Third, eChart record renewal free automatically, even though a signed contract. That breaks the rule that revenue should only be recorded when the confirmed agreement. And this issue will cause overstarted revenue, missing liability, and many mislead investors.
In my research in their accounts receivables, one of the many problems I found is that they haven't been allocating for bad receivables since 2021. And one of their senior management commented that write-off does not exist in our industry, so why allocate allowance, which will only lower our profitability, which is highly concerning. Another problem I found is when they factored with recourse $1 million of their account receivables, they removed $1 million of their account receivables before actually collecting their receivables with recourse. Additionally, they recorded the amount incorrectly recording $30,000 in interest expense instead of holdback, with another duplication of this mistake happening after they collected it. I suspect they wanted to decrease their growing account receivable since they removed their account receivable at the fiscal year end of 2020, and their company went up for sale on December 31st, 2021, and they wanted to make an appearance in their 2021 fiscal year, and also it increases their cash flow significantly.
Hi, I will be talking about building, computer hardware, and office equipment and investments. For the building part, IAS 23 is violated since the borrowing costs are capitalized beyond the ready-for-use date. Similar to the depreciation, which is related to the moving-in period, violating IAS 16. The asset cost is overstated and the net income is understated due to depreciation cost that is not recorded for 3 months. And for the land and lease restoration part, IAS 37 is violated because there is no provision recorded for the restoration cost. The present value of $120,000 should be recorded as restoration obligation and should be recorded as an asset under land and should be depreciated over the period of 30-year lease. Moving on to the computer hardware and office equipment, IAS 16 is violated as the initial cost of the asset omits discount. The upgrade of the asset is expense instead of capitalized, and the trade-in disposal is incorrectly recorded. Initially, the transportation cost and the discount should be capitalized, and the upgrade of $400,000 should be capitalized instead of being recorded as an expense. The trade-in allowance of $50,000 should not be recorded as an expense. Overall, the asset and the retained earnings are understated.
In 2018, the company expensed $100,000 in transportation, insurance, installation, and testing costs pertaining to the server farms. All of these costs are directly attributable to bringing the asset to its intended use and therefore should have been capitalized. Additionally, the company failed to recognize impairment of $452,183 since the farms did not produce the expected revenue. As a result, the assets were overstated and the depreciation expense has been recorded incorrectly. In 2021, the management ordered a change in depreciation method for furniture and fixtures, but the decision is not supported by any provable change in consumption patterns. Additionally, the management also ordered a revaluation of the furniture, lowering its net book value to $200,000 instead of $390,000 as calculated by the provided cost, expected useful life, and depreciation method. Although the visible wear and damage is potentially grounds for a lower net book value, the change should have been recorded as impairment and not as revaluation.
Moving on to the investment, there is a failure to measure the value of investment at fair value for Tesla and IBM shares. Because the shares are available for sale, the shares should be reported at the fair value. And for the national bank bonds, it depends on the decision of the management to hold or trade the bonds. If the management is trying to hold the bonds, then there is no need to recognize the fair value. But if the management wants to sell the bonds, then the losses or the income should be reported to profit and loss or OCI. Thus, there will be an understatement of losses or profit through net income and OCI.
eChart's treatment of government grants has also not been up to accounting standards. The $500,000 grant should not have been recognized as income in 2018. Instead, the company should have deferred the revenue and recognized it over time as it satisfied the conditions of forgiveness, and retained the remainder as liability to be paid back to the government. Out of the 5 years for which the grant has been granted, eChart only met the conditions of the forgiveness in 3 years. As a result, assets were overstated and the retained earnings account has been overstated by $200,000.
So as you can see, eChart is facing several accounting issues, raising concerns about both transparency and financial integrity. They have not followed many of the generally accepted accounting principles.
Using the IFRS framework, eChart's financial reporting is missing fundamental qualitative characteristics, hindering the ability to make an informed decision, specifically lacking materiality through omissions and misstatements on the financial records. They're also lacking representation faithfulness, which requires completeness, neutrality, and freedom from error. Reviewing eChart's records has uncovered many examples of information asymmetry. Their method of revenue recognition, their treatment of accounts receivable, and the reporting of investments are all examples of adverse selection. Even more egregious are their instances of moral hazard, which includes biased changes in accounting policies, their treatment of government grants, and their method of recognizing capital building costs. Due to their misleading and incomplete financial reporting and a lack of internal controls and oversight, we wouldn't recommend the acquisition of eChart unless there is a full forensic audit and revaluation using the IFRS framework to ensure relevant and reliable information to get a complete picture of the company.